What's going on, you guys? My name is Zach Hartley, and in this video I'm going to break down for you my two favorite trading patterns. I'm going to show you how to identify them in the charts, I'm going to show you where to put your entries and your exits, and I'm going to give you a bunch of examples as to where these patterns have happened in the past so that you can better identify them in the future. Here is everything you need to know. Let's go. Now, when we start talking about chart patterns, what I am referring to is technical analysis and drawing patterns on the chart around the price action. So as the candlesticks or the line chart, whatever you decide to use, as that price moves up or down, what we're looking for is patterns based on that price action. What you do need to realize though is that these patterns do not always work out. They work out a certain percentage of the time, and you need to gather the data based on your analysis to understand what that percentage is and then apply it to your trading. And that's what we're going to talk about here. Now, the first pattern that I want to talk about is the falling wedge or descending triangle pattern. Everybody has different names for these. It doesn't really matter here, but what you're looking for is the principle and the methodology behind it. So to identify one of these patterns, whatever you want to call it, I call it the falling wedge, or I probably call it the descending triangle a little bit more often, but the 5 steps that we are looking for to identify this in a chart, here's an example of it. So number 1 is establish support. As you can see right here around this $115 mark, the price basically kind of tested it a couple of times here in the middle of May. It didn't really move around this 115 mark, so we have very clear support established around 115. Then it bounces off 115 right here at the beginning of June, and it runs way higher. So check 1 is established support. Check 2 is established high. The price ran from 115 all the way to a high of around $147 here, and then it got a hard rejection at 147. Now we have an established high. The third thing we need for this pattern is a slow consecutive downtrend back to that same level of support. So we hit our high of 147, and then over the course of August, September, October, November, and at the basically beginning of December here, end of November here, we hit that 115 mark. So as you can see, over the course of 6 months, we went from 115 to 147, and then a slow gradual descent all the way back down to 115. So that was check mark number 3 for identifying this pattern. The next thing that we need is a clear bounce off of support. So as you can see, price comes down to 115 here, and right around here, right around the end of November, we get a very clear move downwards toward 115, and then a very clear green day, big move up off of the 115, 117 kind of level. And then from there, that was number 4. And then the 5th thing that we need to confirm this falling wedge or descending triangle pattern is a breakout of the trend line. And so to draw this trend line right here, we are going from the high all the way and connecting the peaks. And as you can see here, right around this day, basically the last day in November here, we broke through this trend line, and that was the final confirmation that we needed in order to identify this trade as a descending triangle or a falling wedge. So number 1, established support back here in May. Number 2, established high right here in August at 147. Slow, big rejection at 147. Checked off, no problem here. Slow gradual descent back down to support, a bounce off of support, and then a breakthrough of the trend line. Those are the 5 things that you need in order to call this a falling wedge or a descending triangle. And when that happens, and when you can identify those 5 things and when they'll line up, you are usually looking at a big run in the stock price. And as you can see here in Electronic Arts, the stock price ran from, let's call it 125 here, all the way up to a high of 145 here. So a nice kind of 15-20% swing that was easy to identify, easy to get in and out of. And look at this, the stock ran up in a matter of 2 weeks. It ran 15%, which is absolutely phenomenal. Now, if we were looking at this trade and saying, okay, we are going to get into it, where would you put your stop loss and where would you take your profit? Well, this is where I would put it. So the red line here, this is going to be my stop loss. I am putting it directly underneath support. So as you can tell here, there's support at 115. I am putting this stop loss underneath support so that if the trade goes against me, I am out of the trade, it takes me out, and I don't have to worry about it. Now, as you can see here, it did break through the stop loss and kind of tested this 110 level here on one day. This is kind of that doji star candle where it goes up, it goes all the way down, and then it closes pretty much where it opened. You can't really predict these, you can't really plan for these, and so on this case, the longer you wait for confirmation, the better off you would have been. So if you had waited for it to test 115 and then bounce again and then start to move higher, you could have bought in on the breakout here and got in at 122, 123 and still rode that all the way up for another 15 or 20%. Or if you buy in early and you buy in on the first bounce off of support, you risk a little bit getting your stop loss hit a little bit early. So it depends on where you want to get into this. You can buy in on the first bounce off of support, you can buy in on the second bounce off support, you can can buy in when it breaks through the trend line or the resistance here. You can buy in 1 day closing after any of those. It really comes down to your personal preference and your risk tolerance, but anywhere in here, you could have put the pieces together and said, okay, we have a descending triangle here, stop loss goes right underneath support, and your take profit goes right before the previous level of resistance. So that one for us would have been right here around the 145 level. You would have got out right here and you would have closed out your trade. It would have been very, very successful. Now, I did trade EA, but I actually traded the options. So this is my exact trade. This is exactly how I think about it. I actually decided to take the options on this trade, so I don't have a trade breakdown to show you. However, this was a trade that a couple of people in my Discord chat took. This was on Workhorse, and as you can see, we've got the exact same pattern. We've got support coming in here at around that $13, $14 level. We've got the stock running all the way up to a high of $31. We've got a slow and steady gradual descent to the exact same level of support right here around that $13.50 level. We've got a bounce off of support here. We've got a breakout of the trend line, and then the stock ran all the way back up to $41. So really, really nice play out on this pattern here. And another example of this, even on a larger scale, so you can apply this to short-term and long scale trading. But here's Drone Delivery Canada, and as you can see, we've got a clear breakout of the stock here. You could have gone in at 70 cents if you were looking at the chart like I was, and you could have rode it all the way to a high of $1.39 today. You could have doubled your money very, very easily if you were just looking at this chart and had this pattern in mind. Now, if you guys are interested in learning more about the stock market and how to understand these charts, definitely consider signing up for my stock market course. It is hosted on Skillshare, and you get a 2-week free trial when you sign up. That means that if you can do the entire 9-hour course in under 2 weeks, cancel your subscription, you get the entire thing for free. There's 1,500 students that have gone through it. There's 100+ reviews. It is hosted on Skillshare, and I promise you it will be the best free online resource that you can find. There's a link down in the description below. Now, my second favorite pattern is something that I call breakouts. Other people have a bunch of different names for it. I call it breakouts, and basically what it is when the stock decides to push through previous resistance or an all-time high. And so to identify a breakout, this is what I look for. So number one is established resistance. So here is Mind Medicine. You can see the stock coming in at 29 cents here. It pushes all the way up to 40 cents. And then we have a big red day right here, very clear rejection. Stock moves all the way back down to around 30 cents. So number one, established resistance. Number two, the stock has to fall from that resistance by at least 5%. Number three, it has to get rejected from that resistance at least one more time. So here, as you can see, MindMed rejected at 40, comes back down to 30, rejected at 40 again. So that was the second rejection at the 40 mark. That tells me that there's very clear resistance at 40, and there is a breakout opportunity. If it went from 40 to 42 to 44 to 46 and just kept zigzagging, that would be more of a channel or just kind of normal trading. What we're looking for here is very clear resistance at 40, because it means when we see a move above 40, that could be an indication of a major trend. And so number one is established resistance at 40. Number two is a big dip of at least 5%. Number three is getting rejected at 40 one more time. And then number four is a breakthrough of that 40 level. And so this is what you need on that breakthrough day. That is where you can say, okay, we are seeing a breakout on Mind Medicine or on Apple or on whatever stock you decide to cover. So let's just play this one out. So we've got a breakout here on Mind Medicine. If I was going to get into this stock at this point, I would buy the shares at a limit or a market price. I would put my stop loss just below the resistance that will hopefully now form support. So anytime you break through a level of resistance, it then turns into support after that for the stock, or at least that's what happens in most situations. Now, I would put my stop loss just below that support, and if the stock continues to run, I would convert my take profit mark into more of a trailing stop loss so that I can ride that stock all the way up, and then as soon as it turns around, it gets me out of that trade. That is how I would handle this trade. Now, just to give you an example of what happened on this trade, I did get into it, and this is what the stock chart looks today. So yes, this white line here at 40 cents, this is the exact same line that was in the last chart. The stock has ran from below 40 cents to a high of $5.07, now closing out at $3.63. I'm currently in at around 65 cents, so I'm up over 600% on my position, but I'm not in quite as early as I could have when I saw that breakout. And so MindMed went from 40 cents to $5.07 because of a breakout, and the reason that it broke out was really, really nice here. So we had that breakout, but there was also a catalyst that pushed it higher at about the exact same time, and that catalyst was Mind Medicine decided to apply to list on the NASDAQ exchange, which would basically be a graduation for the stock to move higher and give a little bit more confidence to the company. And so investors took that very positively. It pushed the stock up, and it was the catalyst behind the breakout. And if you could have identified it on this pattern, you could have got in at like 44, 45 cents. I ended up getting in at like 65 cents a little bit later, but I've still done extremely well on it. Now, another example of a breakout that I'm actively trading right now is Apple. So as you can see here, Apple runs up from $89 to a high of $137. After that, it drops all the way back down to 100 here before slowly making its way up to 137 again. Right here at the middle of December here, it tested that 137 mark again. Since then, it has traded sideways for about 2 weeks, and it has just tested that 137, 140 mark again. I am currently in this stock, and I am very excited about it. I think we're gonna see a breakout here on Apple. So this is a real life example happening right now that I am actively in right now. So if you're watching this video later on, you can pull up the Apple chart and you can see exactly how well I've done on this trade. The next breakout that I want to show you is Shopify. So as you can see here, stock comes up all the way to $1,100. It falls back down, comes back up, and crosses just barely over $1,100 before a big red day, and it gets rejected again and it falls down. It tests 1,100 one more time, gets rejected again, falls all the way back down in November, tests it again at the beginning, first couple weeks of December here, gets rejected again, falls down to 1050, and then finally breaks through, pushes to 1285, comes back down and tests the 1100 support again before moving a little bit higher. And so we have a move here from as low as $850 to a high of $1,285, almost a 50% swing here in a matter of just a couple of months in one of Canada's largest tech companies, which is absolutely amazing here. And so when I look at Shopify, I say, okay, we've got very clear resistance at 1100. We've dropped down by more than 5% several times. We've retested 1100 several times, so we've checked all the boxes there. We have a breakout of 1100 all the way up to 1285, so there was definitely a clear trading opportunity just right there. We've now come back down and retested the support level that was previous resistance, and we have a new trend line forming. Everything looks good for Shopify. If you made the short-term trade, you would have done extremely well on it, and I think you'll still do well on the long-term trade on this breakout. You need to match your trading style to the time frame that you were trading in. It did break through support. It is retesting it, and now what we need to talk about is breakouts and trend reversals and fake breakouts. If it goes through and it's a fake breakout, or it comes back down and tests support, how do you handle that, and how do you know what it's going to do? Well, there's a couple of tips that I like to talk about. Number one is increasing volume confirms the price move. No matter what direction you are going, if day after day the volume is increasing, that move is probably stronger. If the price is going down but the volume is slowly diminishing, it means that probably a lot of people don't agree with that trend, and so they're just going to hold off and wait. But if the stock is skyrocketing and you see increasing volume buying in, it means that there's still probably room to run, and more people agree with what's happening with the stock, so you may want to get a piece of it. Volume can be your best friend when looking at trend reversals and breakouts. Volume is the number one indicator. After that, you want to look at market internals. What I mean by market internals is, what is the S&P 500 doing? What is the NASDAQ doing? What is the VIX doing? What are the other indexes doing? And what is the rest of the market doing? And is there anything in the market that is making everything move up that will just carry your stock with it? Because if that is happening, that can be confirmation. But if that is not happening, or if you are looking at the market internals, the S&P 500 and the VIX, and they're going in a bearish direction and you're trying to buy in a bullish direction, that is an offset that you need to think about and say, do I really want to make this trade? Is everything aligned here, or should I hold off and kind of wait on this one? It might be a fake breakout. The next one you want to really look at is industry comparisons. This is probably my number 2 kind of resource on this list that I like to look at the most. If you see every hydrogen company moving up and yours is going down, there's probably an issue there. But if you see, or you're really bullish on Apple right now and all of tech is going the other way and tech is going down, but Apple looks like there's an opportunity there, I would be very cautious with that trade, because if the entire industry is moving against your trade, there's probably a reason behind it, and you're fighting an uphill battle, you're going upwind, and you will lose that battle more often than not. The last few things here are catalysts. So does the company have earnings or news, or is there anything big happening in the industry right away that could cause this breakout or cause the push higher? Next one is level 2 at crucial levels. So level 2 refers to time and sales of other people's orders. You can see where they stack up on the price, and if you can see that Apple gets to $120 every time and then gets rejected because everybody sells at 120, and then as Apple approaches 120 the next time, there's no orders to sell at 120, that's how you can start to predict the breakout and assume that Apple is just going to crush through 120, and that's when you want to enter the trade. So you can use level 2 to help predict this as well. You can also use indicators. Indicators are based off the price action though, so you need to keep that in mind. Your price action is going to be the #1 tool in your tool belt. Indicators are there just to help you understand the price action. Now, when it comes to trading, there are two main factors that you need to understand, and these are the most important factors. They're your win rate and your risk to reward ratio. Now, when you map these two factors out on a graph, you put your risk return ratio on the left and you put your win rate at the top. This is what the graph looks like. So if you win 30% of your trades or 40% or 50% of your trades, and then you have a risk return ratio of 1-to-1 or 1-to-2 or 1-to-3 or even 1-to-4, this is how you can see whether or not you're going to be profitable. So for instance, if you win 50% of your trades, if you take these two patterns and you go and apply them to 50 trades and you win 50% of them, the risk to reward ratio on those trades that you need in order to make money is a 1-to-2 risk to reward ratio. If you have a 1-to-1 risk to reward ratio and you only win 50% of your trades, you're going to win just as much as you lose, but then you're going to pay conversion fees and transaction fees and commission fees, and you're going to end up losing money. So 1-to-1 at 50% doesn't work. However, if you have a 1-to-1 risk to return ratio, meaning for every trade you enter, there's a $5 upside and a $5 downside, and you win 60% of your trades, then you're still a profitable trader. So you need to keep that in mind, and you need to understand this chart, because depending on the trades that you take and the risk to return ratio and how often you win them, that is what dictates whether or not you're a profitable trader. But this is the golden goose of day trading and swing trading, and you need to keep track of your win rate and your risk to return rate. And the way that you do that is by keeping track of your trades in a trading journal. Now, you can do this electronically, you can do this online, you can keep a little notepad, but what you are looking for is what trading patterns are you trading on, what is your win rate on those patterns, and what is the risk to reward ratio when you make those trades. If you can get that information together and you can do the math on here, then you can figure out pretty quickly whether or not you're going to be a profitable trader or not. Now, if you're interested in seeing more of my trades and more of my technical analysis like what I showed in this video, then definitely consider signing up for my Discord chat. That is where I'm trying to build a community of traders to share our analysis, share our research, and share our basically trading ideas. I share my watch list there every single week, as well as all of my charts, and if you'd like to see any of that, definitely consider signing up with the link down below or clicking the join button next to the subscribe button. I would love to have you there, and we have a community of over 300 people so far. Now, just in summary, when it comes down to trading patterns, you need to find trading patterns that work for you. These are my two favorite patterns, and they've worked extremely well for me in the past, but they take practice, they take some understanding, and you need to basically go out there and try and find them in the real world, because that is what it takes to actually identify these and get in when the opportunity is there. You also need to track your win rate and your risk to reward ratio, because those are the two factors that are most important to your success. And lastly, you need to refine that strategy over time. This is how you improve as a trader, is you make a better strategy. You go out there, you test your strategy, you gather data, you see if it works, and then you refine that strategy over and over and over again until you become a machine at making money, printing money at your computer. That is the goal here, and that is what we are trying to achieve. So if you get any value out of this, please consider hitting that like and subscribe button, and we'll see you soon.